large part of the FI money is also going into stories or countries where there is some sort of a play on the artificial intelligence.
The IIs have taken the driving seat now. So do we really care about them coming back or not? What's the sentiment of the market that this reduction happened? You could foresee this AI wave coming in like a tsunami, or when you hit the bottom, and that's when you kind of reduced your exposure on this.
For the last 4 odd years, we have been underweight on IT. We've, at least in our PMS and our AIF portfolios, the IT weight has been zero. If you see any of our portfolios, mutual funds, alternate portfolios, you will find very heavy allocation on manufacturing side.
If we see NTDOP, inception since 2007, it's been into the market for almost 20 years now. When I see the performance chart on every window, 1 month, 1 year, 3 years, 5 years, it is showing a negative alpha. It's underperforming the benchmark. Only the since inception, that's 20 years of time frame, is slightly above the benchmark, which is also nothing very eye-catching. Do you see that your long-term philosophy as a fund is not playing out, or what is amiss so that 20 years time span makes a good amount of strategy and a good amount of money for the investors? Welcome to Returns and Beyond from Wealth One, a platform of PMS and AIF investments where we bring to you the best of the minds of the financial world, the wealth management world. My name is Narender Agarwal and I'm your anchor. Today, we have a very special guest, Mr. Akhil Chaturvedi. He is the Executive Director with Motilal Oswal AMC. With 24 years of vast experience in the field of financials and wealth management, he brings on table a lot of expertise, a lot of experience, and exactly what goes on behind the curtains. Friends, at 13 years of Motilal Oswal, he has seen the AMC grow to a AUM of 1,60,000 crores, which is into the pockets of mutual funds, PMSs, and AIFs. With 68 offices across India and over 700 people in the team, Mr. Akhil Chaturvedi is a busy man. And today, we're going to have a very candid, crispy conversation about what's going on in the financial markets. And so we welcome him with a big round of applause. Thank you, Mr. Akhil, for joining us at Returns and Beyond.
Thank you, Naren. Thank you for this opportunity.
Okay, so can we get started right away?
Absolutely. Let's go.
Okay, so first of all, let's have a macro view of the financial markets. You have been a big player in the markets, and understanding the macro levels is extremely important for our investors.
Yeah.
So if I see the foreign institutional investors, they have been the net sellers in this entire 1 year, 1.6 lakh crores as net sellers. All of this has been absorbed by DIIs. Thanks to the SIPs, 30,000 crores of SIPs coming every month, and thanks to the direct investments coming from the mutual funds. The reason for the FIIs going away is very clear. The earnings issues, the rupee depreciation, the tariffs, and so many geopolitical issues. Plus, they are having the greener pastures outside. But now, surprisingly, February 26 has been a year where we saw a net buying of FIIs. So this looks like a signal where they're coming in,
Yeah.
So from your lens, we want to understand what is it that Indian markets should be presenting on the tables to the FIIs?
Yeah.
What are the factors that they're looking for to actually come back to the Indian market?
Yeah. No, so very pertinent question, and thank you for bringing up this question right from the word we started go. Now, see, over the last couple of years, we have seen that the Indian markets have delivered some very stellar returns. So post-COVID, between 2021 and 2024, Indian markets gave great performances, and also these great performances led to very rich and premium valuations of our market. So the number one concern for the foreign institution investors almost 12 months back was basically that the valuations were looking very, very expensive, and therefore they were doing profit booking and they were moving out. Then into the last 12 months after Mr. Trump took over as the president, and all the tariff related issues created some sort of headwinds for India, because largely we are supplying a lot of goods and services to US, and if you are tariffed at a very high rate, you become uncompetitive, and that would create pressure on the earnings, especially for the sectors which are dependent on US exports. So from that macro narrative, FIs were waiting and watching, and they were hoping that once the tariff related matters are sorted out, which it has got sorted out, they would come back. Once the tariff related matters got sorted out in the month of Feb, we got the good news, and which is where you are rightly saying that in the month of Feb, you saw foreign inflows becoming net positive. Unfortunately, once the tariff issues went behind us, what has happened is there is a conflict between US, Israel, and versus Iran. Right now, when there's a conflict in West Asia, Middle East, India largely depends on oil imports. From 40% of oil comes from these parts of the world, which would mean that our macros could get impacted, probably will get impacted. Our growth could come down, inflation could move up, that could lead to maybe higher rates and overall slowdown. So now this is another concern at the macro level, which is looming over India, which is turning the FIs back to their own country, right? The other issue over the last couple of weeks for foreigners has been that the US Treasury yields has reached all-time high of like 4.3% or something like that. Now, if your safe assets back home in dollar terms giving you 4.2, 4.3% kind of risk-free return, then why would anybody come into an emerging market like India, take the risk for 200, 300 basis point higher return, coupled with falling rupee, currency depreciating also takes away a large part of your return. So higher US Treasury yield is also a very critical reason for the foreign institution investors to move out. So now we are talking about valuations. And now if you compare this to why they should come back to us, right? Some parts of the narrative is looking better, more from valuation perspective, which was the original worry of these investors. Valuations today, after the corrections we have seen, both time correction as well as price correction over the last 18 months, has led India to become a underperforming market relative to the world market, relative to the emerging market, and relative to some of the key countries like China, emerging markets, so on and so forth. Right. So the valuations have become a lot more comfortable today for the investors to look at us once again, right? The other narrative I would also like to add is that largely India has also been a anti-AI trade. So large part of the FI money is also going into stories or countries where there is some sort of a play on the artificial intelligence, whether it is to supply hardware like semiconductors, chips, so on and so forth, which is where Taiwan and Korea are benefiting, and we've seen how the markets have done. Or whether it is in US, you continue to see very strong tailwinds for tech-oriented or AI-related businesses. And India largely has been away from the AI story. We are in conventional businesses, so that also has been a theme which where they are very excited, but we are not able to offer them any idea, right? So I think when will they come back? Hopefully sooner than later. Comfortable valuations. Hopefully, once this war comes to an end and the US Treasury will start to taper down, that will make them risk on, and they will look at emerging markets once again, and then they will some part of the emerging market allocation will come to India. I think what India is offering is an opportunity where there are. I think it's one of the most diversified market in terms of these sector level opportunities, and a lot of sectors are now, a lot of businesses and a lot of new sectors are now coming into public markets through the IPO route, right? So if you see over the last 5 years, the entire capital market sector has opened up. A lot of the brokerage firms, asset management businesses, insurance businesses, exchanges, these sectors were not available 10 years, 15 years back for any institution investor to buy in. Today that sector is open. A lot of spaces have opened up on the renewable power side. A lot of spaces are opening up on the manufacturing side. A lot of spaces are opening up on the new age digital technology businesses, right? Many IPOs have come. So our market has become very broad based, very diversified, and we are offering our own growth story playing out through some of the very high growth sectors and themes, and that is what one has to really participate in. So I think large part of selling is done. Now the FIs as a holding in the Indian market cap has dropped down from 21% to 16%, right? So 9% drop. Uh,
And DIA holdings is
and DIS has gone up
increased.
to
They have
19%. Yeah,
overtaken
they have.
the
Yeah,
FIA holding.
it's basically a change of hand. Stocks
Yes.
have moved from
Yeah.
Goras to locals, right? So that is what has happened, right? So beyond a certain level, I think all this selling, which is largely coming from the ETF, will dry up. There will be nothing really left to sell out, because at some stage, I don't know what percentage, whether it is 12% of the market or 13% of the market, but that part of the market is the sticky asset. So these are the sovereign funds, global funds, more strategic, long term in nature. They don't go in and out, and they take strategic bets, right? So that should be, I think, 12, 13% of the overall FI allocation. So maybe another 2, 3%, worst case, we may see some more selling to that extent. And then there will be like a bottom out, right?
They'll be bottoming out. But I
Yeah.
would like to just train your focus on few facts here. When we see from the FII's lens, okay, so Nifty is giving us a 10% in the last 12 months or so. Dow is giving us 14%, Nasdaq 21%, Taiwan 44%, Kospi 118%. Yeah. So why would FII come to India when he has Kospi, who has 118% of returns in the same time frame? Yeah. So
No, Naresh
and
ji,
then also the rupee
yeah,
depreciation.
yeah. See,
So it doesn't make sense for them to be in the Indian market. How is this going to play out if these markets, the global markets, continue to give returns? I don't see any kind of a way back for FIS very
yeah,
soon.
yeah, yeah. No, sure. So see, FIs are smart guys, right? They are always looking at value spots. Where is their value available, where they can buy cheap and sell expensive. Now, most of the markets which you're talking about, which is a Kospi or a
Taiwan.
Taiwan, and these markets, or for that matter, even US or China, uh, they entered these markets when these markets were cheap, and those were the times when India was expensive. That's where the change of hand happened, is where the money moved out of India and moved into the emerging markets and their own local market, which is the US
Hmm.
market, right? Now, what has happened, like you rightly said, just to correct you on the India return, in dollar terms, actually it is negative now on
Yes,
a
of course.
12-month basis.
Yeah.
Whereas these markets have given very handsome double digit returns. So at some stage, maybe they will do profit booking outside in those markets, and they will find India as a value pot or a great opportunity, right? And there is where that change of hand again will happen in favor of India. So that when that sweet spot happens, what is their comfort level, what is the valuation they are looking at, that time will say. But as of now, the opportunity for India is a contrarian bet, because over the last 12 months, India market is underperforming the world markets. If you put the entire world market return for the last 12 months is about 17%. India is -4 or -5%, right?
If you see the depreciation
Yeah, if
also.
you add the in dollar terms,
Yes.
right? So, and we are doing dollar to dollar comparison. If
Yeah.
you compare India with emerging market, emerging markets have done 31% return. So it's like a 40% underperformance to the emerging market. So India, with very strong macros, with earnings growth coming back, valuations looking very attractive. I'm sure at some stage there will be change of hands. There will be rotation. So I'm more optimistic that after such a rampant sell-off, one, the pace of sell-off will keep getting smaller, which we are seeing now in the last 3 or 4 weeks. The pace of selling has halved, which itself is a good news. It will come to zero, and then it will come back.
Hmm.
I think the first trigger should be when this war comes to a conclusive end, which will lift off this whole worry of oil prices going wacky, which can have a massive impact on Indian macros, right? So I think that is a wait and watch, which is perhaps happening more specifically in case of India. So it's a matter of time. I agree with you that we don't expect them to come back anytime soon, but it's not going to be that they have gone forever, right? At some stage,
Absolutely. So
some stage they will come back.
there was a point in time in Indian markets where the movement of FIIs, when they were blinking an eye, the markets used to catch fever.
Yes,
That's not the case any longer.
absolutely.
DIIs have taken
Yeah.
the driving seat
Yes.
now.
Yes.
So do we really care about them coming back or not? What's the sentiment of
No,
the
we do.
market?
We do care. We do care. We are very very lucky that over the last decade or so, Indian retail investors, domestic institution investors have started to think very differently in terms of the asset allocation. So prior to this decade, a large part of the Indian allocation largely used to go into real estate, gold, and fixed deposits. People have a higher buy-in now in the Indian growth story, Indian economy, and the stellar returns which Indian markets have given over the last 5 years and 10 years. That's built their confidence. So what we have seen is that the Indian ownership of Indian investors in the Indian markets from as low as 1% today is 5.5%. Right now, if you see the overall household assets of Indians, all put together, real estate, gold, fixed deposit, equity, everything put together is roughly 1,200 lakh crores, out of which 5.5% is in equity. Every 1% shift from Indian retail households from all the other asset classes into equity, which means a movement of 12 lakh crores annually, which is the number you see in mutual fund gross flows, 8 to 9 lakh crores every year. So in 5 years, next 5 years, if every year there's a 1% movement, so in next 5 years the penetration will double from 5.5% to 11%, which will mean incremental 60 lakh crores coming into Indian stock markets via
Equities, yeah.
mutual funds.
Yeah.
I'm just saying mutual funds. You can add direct equity, you can add insurance, various other pension funds. EPFO is allowing you to put money in equity. So there are various sources how the money is coming in. So one, that asset allocation shift, people are willing to take risk. People have had a good experience. People have a greater buy-in in the India story for very long term. I mean, this whole thing, of thinking India as a Viksit Bharat or a developed economy in the next 25 years, this shift has changed the asset allocation platform in favor of equity. And this liquidity which is coming inside has completely absorbed the sell-off of the foreigners.
The foreigners, yeah.
So there was a time before, let's say, before 2010, when, like you rightly said, foreigners used to come and then we used to come, and foreigners used to go, after that we used to go. At the end of the day, we were coming on the tops and going on the bottoms, and the goras were making a lot of money. Today it is different. Today they are selling, we are buying. At some stage, probably when they will come, Indians will do some profit booking and change of hands will happen, right? So we are behaving very, very differently. But it's not about markets, it's not about returns. See, we are talking about India is a emerging country. People are just about, getting some money in their hands. The per capita is just about to, kind of reach a level where people have something to, first earn meaningfully, then invest meaningfully and spend meaningfully. So from, let's say, $3,000 per capita, the journey is to $15,000 per capita, maybe in the next 15 or 20 odd years, right? So people are just about earning, and they want to improve their lifestyle over long term. They want to have a very healthy retirement. They want to get their kids to study in great schools and universities, or good marriages. It's a typical values of each Indian household, right? And for which they have understood that a 5%, 6% fixed deposit cannot get them to achieve their goals. Therefore, they have started to add equities.
Equity
Therefore,
into
they are looking at long term, and therefore, in the month of March 2026, probably will be written down in the history. When the market went down 12%, you saw highest inflow of 85,000 crores in Indian mutual funds itself,
Yeah.
right? Which means that they have also understood that one has to buy the dips. If at all you cannot, if you are not able
So-
to resist the tops, at least buy the dips.
So the Indian investor is getting matured.
Absolutely.
Yeah, and he's
absolutely.
getting more informed.
And way to go.
Yeah.
We are a population of 1.4, 1.5 billion people. And you have what, 50 million people who are investing in
Is
mutual
actually
funds,
investing in
or maybe 120 million people who are directly or indirectly into equities through direct equity or mutual funds.
PMSs or
Yes,
AIFs.
yes. So it is long way to go.
Okay, so now just shifting a little focus on Motilal Oswal as AMC. You are one of the biggest players in the market. Offices in 68
Yes,
cities.
yes.
And I was reading one article that says you're touching 90% of the pin codes
Yes.
of India.
Yes.
So you've penetrated basically to every nook and corner of the country, right?
Yeah.
So when we look at the investor geography of states, okay, 4 or 5 states come up uh, importantly. That's Maharashtra, Delhi, Gujarat, Karnataka, and West Bengal. If you look at the cities, it's Mumbai, Delhi, Bangalore,
Chennai, Ahmedabad,
Calcutta, Ahmedabad,
Pune.
Pune, coming in the top five, right? Uh, so if I look at the data of the tier two cities, that's probably Chandigarh, Surat, Baroda, and cities like this, they have the maximum growth rate that is coming up. Yeah. So, how do you see this, perceive this as to which are the pockets where you feel that the investor is now getting matured?
Yeah.
And he's coming out of that FD culture and getting into that equity zone, number
Yeah.
one, and getting mature enough to buy the dips.
Yeah.
Yeah.
No, it's happening. This is it's a viral which is spreading at a very fast pace across the length and breadth of India right now. If you see, if you have to understand, I think mutual fund is a better way to understand the penetration of equity, right? So if you see 30% or maybe 35% of the incremental flow is now coming from B30 locations, below the top 30 locations, right? That is the market, the below 30 markets is where the growth rate is far higher than the top 30 markets. So if the top 30 market is growing at 10% and the B30 markets are growing at 20-25%, because there is where is that the bigger population is out there. There is where the incremental prosperity is happening. Those are the cities which are getting developed very faster. Therefore, prosperity, therefore more income, therefore more awareness, and therefore much more evolved decision making into the overall
So
asset
that
allocation
means
platform.
AMC should be focusing more on the B
You have
towns.
to focus across. See, we have to focus across India. I mean, that is the direction which as a AMC, when as all AMCs, when we sit together, we want to really get 50-60 crore people to invest. So therefore we have to do penetration. But even the regulator is trying to push asset management companies to invest further into smaller towns, smaller cities, and develop a culture of saving and investing and the right way of investing, so on and so forth. The media is helping quite a bit. Podcasts like these are reaching through reels, through the digital medium, social mediums, social media, I don't know which part of the town who's listening what and who's making what decision, right? So the ultimate the top markets are saturated. Like the top 10 markets, people will have decent allocations, meaningful allocations. It's the tier 2 and the tier 3 cities where the allocations are right now very, very small, right? So the incremental growth will come actually from there. Another data point I can share with you is the digital platforms. I mean, the digital platforms which are like Zero Dhas of the world or the Grows of the world. These are the platforms which are giving that that experience, ease of opening the accounts, and so they, if you see their growth is largely, I think their growth 2/3 is coming from young investors, 2/3 of the growth is from the
B towns.
B towns. They are getting these new investors who are simply downloading the app. They get the top products over there and they are simply buying the products over there, right? So the digital mediums, the digital distribution channels, social media platforms like yours. I think you are also doing a lot of work digitally, right? So I think this is how this whole spread is happening in terms of the culture of investing, then culture of saving, right? Saving means fixed deposit, investing means equities growth,
Let your
right?
money grow.
So
Yeah.
so people have understood that we don't want to save money, we don't want to protect, but कुछ होना चाहिए protect करने के लिए, right? So people want to make 1 crore rupees, people want to make 5 crores, 10 crores, and what can help you to achieve those goals? Of course, it comes with time, it comes with compounding. You need to know the do's and don'ts, but eventually, if you want to make that kind of a corpus for a very comfortable living, then there's no other way but to have some meaningful allocation in equities.
Okay, so Akhilji, like you said, wealth one about we are more about PMS and AIF. So I want to shift my focus to PMS. Um, uh, Evaluating your majorly your four PMSs that you have in the multi cap and the small and mid cap. That is NTDOP, mid
To
to
mega.
mega,
Value migration.
value migration, and founders fund. Okay. Uh, I have a specific. I was looking at the sectoral allocations. Okay, I have a very specific observation. 6 months from now, you were very heavy on IT sector. Okay, now you have toned it down. So IT sector from the last, if we see from 2025 to Feb 26, come down from 40,000 to 30,000. That's a 25% drop. And now we see that you have reduced your sector weights in all the four PMSs. Okay, this reduction of IT index is in all. It was because of the AI disruption, was because of the tariffs, and was because of the outsourcing demand that was drastically reduced, suddenly reduced. Uh, uh, so my question to you is that this reduction happened. You could foresee this AI wave coming in like a tsunami, or when you hit the bottom, and that's when you kind of reduced your exposure on this. So what was happening behind the scenes?
Yeah, no, so actually, if you look at, just to correct you a little bit out here, actually, for the last 4 odd years, we have been underweight on IT.
Mm-hmm.
We've, at least in our PMS and our AIF portfolios, the IT weight has been zero. The IT sector in our alternate portfolios, we have played through the new age digital businesses rather than playing the businesses which were the traditional offshoring businesses. So we have
So,
been zero weight on any of these large cap IT companies.
mhm.
Our IT or tech participation largely is through digital companies or very selective 2 or 3 plays in the mid-cap IT sector, which is largely to do with innovative products and services rather than doing coding work. So we have stayed away from coding-oriented IT businesses. We have whatever allocation, meaningful allocation we have done is more on products, services, and digital platforms.
So when you say new age digital IT sector, so can you name what kind of stocks that you were in?
So we were the early ones to get into food tech platforms like Zomato. When after the IPO frenzy, when the business corrected and we got a lot of comfort, we were the early buyers into Zomato. I mean, that was the first entry we made. If you talk about on the fintech side, we have selective participation through Paytm or through eMudra, which is a compliance company. Or maybe Policy Bazaar. These are some of the names which we have in our portfolios, which are basically giving you solutions on the tech platform for variety of sectors, right? So we are talking about compliance sector, we are talking about fintechs, we are talking about, let's say, very recently we have added into the largest fintech broker, which is Grow. And that's done phenomenally well in our portfolios as well, right? So that's been the latest entry. So any company, any digital company which is offering a meaningful value, demonstrating very strong growth, and see the incremental growth also will happen to any business where there is a adoption of technology or disruption in the conventional way of doing business. So that space, our tech space, is largely these spaces, and some of the names which I've given you are the names which are part of our portfolios. So you will not find Infosys or TCS or HCL or these names in our
So
portfolio.
what is because your fund manager was able to see that AI
I'll
disruption?
explain to you. So
Yeah.
basically, you have to understand our philosophy. Our philosophy in picking up or choosing businesses is largely dependent on how the earnings growth of the company does. So we are growth investors, and we love to buy businesses where the growth rates can be meaningfully higher than the index earnings growth. And in long term, our belief is that growth is equal to return. So if I buy into a business which is making 100 rupees profit today, growing its profits at 15%, doubling to 200 rupees in 5 years, and that 100 rupee company which makes 100 rupee profit is today at 1,000 crores of, or let's say 1,000 rupee of market cap, if it makes 200 rupee profit, at same P multiple will be 2,000. So that's the underlying belief. We love to buy companies on earnings growth rather than what is happening on the price. And eventually the belief is that growth will result into the return, because if your profits are going up, the value of the company is going up, and it will at some stage reflect in terms of the market cap or in terms of the returns, right? So therefore, now to choose growth, we have to hunt for sectors or themes where the growth is going to be very high. It's a top down approach. So we have 6 or 7 sectors. They keep changing, rotating from time to time, new opportunities. But broadly, we will have 6 or 7 very high growth themes. Then we have sub themes, and then from those themes we pick and choose
The
some of
stocks.
the top businesses. So there's a process. There's a process in how we identify growth into zeroing in on the businesses we want to buy
So,
within
what are
the
the top
themes.
two sectors
So,
that are?
for example, if you see any of our portfolios, mutual funds, alternate portfolios, you will find very heavy allocation on manufacturing side. Now, within manufacturing is a big theme, right? Now, within the manufacturing, there are two opportunities. There is a China plus one opportunity, which came up after COVID. That now supply chains in some way will move out of China, or at least there will be a de-risking, and countries like India will benefit. And we are seeing some spaces where this opportunities is transmitting, right? The other is the Make in India theme, right? So there is a lot of focus of our government also in pushing the manufacturing, let's say from 12% to GDP to maybe 20% to GDP, right? So a lot of political ambitions and aspirations also get fulfilled with manufacturing, because that will also eventually create a lot of employment, and these data points are very good for their narrative, right? But eventually, if India has to grow at 8-9% meaningfully for very long term, this manufacturing bit is very, very important. The whole tax reform, which was done a couple of years back, when the corporate tax cuts were done from 35% to 25%, and if you set up a new business, it's 15%, and for startups, it's zero tax for the next 3 years, right? So if you see the tax reforms on the corporate side, startup side is also another initiative of the government to push manufacturing or entrepreneurs to set up their shops, set up plants, set up factories, and boost that thing, right? So that is a very, very large space. Typically 30 to 40% of our portfolios is in this space, and underlying it, there are multiple opportunities. Let's say consumer durable is one opportunity, power sector is one opportunity, defense is one opportunity, capex oriented businesses is another opportunity, pipes and cables and wires is another opportunity, right? So it's a very diversified
Yeah.
space.
So the
Two-third of our
sub-segments, yeah.
two-third of Nifty 500 is all about manufacturing. It's a very large space. So there is where we are over allocated. The second theme is the very large theme, which is the financials. Now, financials, you have three parts. You have banks, you have NBFCs, you have capital markets. Fourth is insurance. So you have four sub parts. Largely, we have been underweight on large banks, when we have been overweight on NBFCs, because the growth rate of NBFCs has been higher than the growth rates of the banks, and therefore we chose to participate in NBFCs. It has helped us, outperform. It's been one of the key reasons, right? And third is capital market, because as we are discussing, financialization of savings is a very, very important theme. Asset allocation mix changing in favor of equities, which is boosting stock exchanges, which is boosting capital market intermediaries, which is boosting brokerage firms, it is boosting asset management company, right? So it's a very, very long-term constructive theme.
Please.
So, and then finally, we have selective play on the insurance. You have life insurance businesses, you have general insurance. We like general insurance business. So we have some exposure there, but we typically don't have life insurance. At hopefully some stage we'll have that also. So that's the second theme on the financials. Very contrarian to what the industry does, where you'll find higher position on banks, lower position on non-banks. In our case, you have higher position to non-banks, lower position to banks. Second. Third is our tech position, which I explained to you. It's actually zero weight on software companies and heavy weight on new age tech companies. So that's a very differentiated tech exposure. Consumer, again, a large part of India. You have consumer staples, right? Or companies which give you day-to-day essentials, like FMCG companies. We are zero weight, because we feel that incrementally, how much ever more money people will make, you will not eat more rotis and more chawals and more Maggi noodles and all of those things, more toothpaste, right? But incremental money or incremental per capita is going into upgrading lifestyles. So if you want to wear good clothes, you want to do good tourism, you want to buy good consumer durables, or you want to buy good real estate for yourself, right? So the consumer discretionary is where we see the growth rates are going to be high, and therefore our consumer exposure is higher on the discretionary, and absolutely nothing actually on the staple side. And then last theme, just to conclude, is the healthcare. Selectively we are playing healthcare. Largely we have played hospitals or diagnostic companies. Again, stayed away from the conventional healthcare story, which is played through the pharmaceutical companies. but largely we have been non-conventional and participated into the newer opportunities like the hospitals and the diagnostics. So these are some
Okay,
spots.
so let's pick up your major theme, that is the manufacturing or the capital goods. So if I see the capital goods index, okay, this has been growing phenomenally well. Last 5 years, CAGR would be around 25%,
Yeah.
and you have been part of this role on, and as you rightly said that you're very heavyweight on the capital goods, right? Uh, Last 1 year, the capital goods is just given 4% return. So there, it looks like that it's halting. It looks like that there is a stagnation coming here. The government spend is there, the defense spend is there, the power sector, the renewables is there. So does it make sense for you to be still heavyweight, or is this a conviction, or is it just that there can be a slowdown that can come into the sector?
Yeah.
So we want to understand this.
Yeah.
What is in the mind?
Yeah. So what I was explaining to you is that we are overweight on manufacturing as a theme, within which capex is a small sub theme, right? So if you see in the overall manufacturing exposure, capex would be maybe 4 or 5%, and then eventually, what we have to see is that you may have a sector which might be going through headwinds, it might be going through a slowdown, but within that also you may have one or two companies which are doing better, right? For variety of reasons, for maybe better products or for better pricing or better brand or whatever it may be, right? So we are at at one stage we do look at top down, that okay, which are the top sectors, top themes. Eventually, two-thirds of our effort is to identify that right script, the right company, because we are focused investors.
So, 1 second, I just want to just have the correction in the figures here. If we see all your four PMSs, you are heavyweight on capital goods.
Manufacturing, within which capital goods is 5%, 6% weight, two or three companies.
Okay, so in your sectoral, this thing is capital goods is 20%, 15%, or 25%.
No, that's manufacturing. That's manufacturing as a
As a
larger,
theme,
as
okay.
a broader theme.
Okay,
Within the
please.
broader theme, capex is one sub theme.
Okay.
Defense is one sub theme, right? Let's say cables will be one sub theme, or power will be one sub theme. Now, so within the 35-40%, there are sub allocations. So let's say we are overweight on power, renewable power, which will be maybe 10-12%. Then we have been overweight on these cables and wires companies benefited. That would be maybe 5-10%. Then capex oriented one or two businesses will be maybe 4-5%. So it's a larger theme, 30-40%, and then 5%, 10%, 2% exposure to sub themes, and then the businesses,
other
right?
themes.
Yeah.
Okay, fine. So just want to understand that, do you see that slowdown coming in, or is it a conviction that this theme is
No,
going
in
to stay?
fact, if you see, capex is also a very broader theme. I mean, right? But large part of the capex businesses, largely the industrial plays, or basically some of the infrastructure ancillary companies. There are a lot of, like in autos, you have auto ancillary. In infrastructure, also you have some of the companies which are in the value chain which support the broader theme, right? So we are looking at spaces where there is something which is playing out, which is giving the positive growth momentum. Now look at the large part of capex, right? Like you rightly said, is actually done by the government. The government for the last many years has been spending 10 to 12 lakh crores in building roads, railways, ports, highways, infrastructure. Large part of the capex play is actually benefiting from the government spend, right? So there is where the opportunity is coming, right? So the private sector capex has been muted, but the government sector capex has been huge, and that has been largely supporting our economic growth also. So it's not that the sector is slowing down, right? The sector is growing at a very healthy rate, right? Now within that there will be high growth companies, there will be low growth companies. Like we spoke about technology. Within technology, you have the large cap IT companies which are in a slow growth, but the mid cap IT companies are growing 2 times higher than the large cap IT companies. So there is always a process, but eventually it bottles down to what do you own, and what you are owning, irrespective of which sector it is coming from. As long as that can demonstrate a doubling or tripling of profit over 3-5 year time frame, that gives us a comfort. So don't get too sticky on how much we are putting, get down to eventually what kind of businesses we have and what kind of growth rates of those businesses. See, underlying theme, keep in mind, is that we would love to have businesses which can do 3-4% higher growth than the benchmark. Right now, from wherever I get it, we get it. Right, like we spoke about insurance. Right now, there are plentiful of companies in insurance, but I just have one company out of all the companies which are available. Right, so I may call it as a theme, but within the theme I could identify only one company which suits my investment framework or
Okay.
investment
So
philosophy.
if we talk about the financials, which is the second most heavy on the PMSs as a sector, and you said that you are into NBFCs and not
Capital markets, that's been overweight here.
yes, it's a quite overweight, and I want to understand one thing: PSU banks have been is not visible in your
Yeah.
portfolio,
Yeah.
right? Whereas PSU banks have done fairly well in the last 12 months. So, is it missing out on the rally, or you feel that there is a conviction with the NBFCs
Yeah.
or the other
No,
intermediaries?
we are open to everything. Like I keep coming back that if I have a bunch of NBFCs which can give me 15% plus or maybe 20% plus growth, and then I have a bunch of banks, whether they are PSUs or private sector, we have been absent on both the sides, right? And they are growing at 12%, 13%. Then what do I choose? Right. So we have chosen to, on the lending side, we are finding the NBFCs as better lender in terms of growth and valuation than banks. But these things keep changing. So over the last 3 months, we have now selectively started to get back into banks because we feel that the credit growth is picking up. We feel that bankings have been battered down too much, so the valuations look compelling. So selectively, we are adding
The
into
banks into so
several
the
banks.
private ones or the PSUs?
We have higher, better comfort on the private sector for now, and within that, maybe one or two names on large cap, but several names on the mid cap banks, where again the growth has to be higher, right?
So what mid cap banks would you like to
So
just give
currently,
it
if
to
you
our
see our
investors?
portfolios, you will find an IDFC bank, you will find a AU Small Finance Bank, you will find an IndusInd Bank. These are the three mid to small mid cap banks, actually, not small banks. And on the large cap side, you will find Axis Bank and ICICI Bank. So these are the five banks where we've started to build our position. But when you see the NBFC side, you will find 7-8 names over there with a very I mean, it's visible. If you've seen our portfolio, it is visible that it's like a good 10, 12, 13% weight to that. So we are open. Tomorrow, if PSU banks give me that potential of giving consistent, sustainable, long-term growth at a good price, we are open. And in the past, we have bought in. So there is no to anything.
Yes.
As per our understanding, what is looking good to us today is where we want to participate. So we are open to everything.
So Akhilji, you said that you're open to everything, and your main focus is to generate that alpha over the
Absolutely.
benchmark, which is like 4-5% over the benchmark, and you're happy. Uh, Let me have a view on a particular your flagship PMS. Okay, so I am from the PMS industry, so I will talk about PMS more.
Yes.
So if we see NTDOP,
Yeah.
okay, inception since 2007, it's been into the market for almost 20 years now. Okay, when I see the performance chart on every window, 1 month, 1 year, 3 years, 5 years, it is showing a negative alpha. It is not. It's underperforming the benchmark. Only the since inception, that's 20 years of time frame, is slightly above the benchmark, which is also nothing very eye catching, you can say.
Yeah.
So, do you see that your long term philosophy as a fund is not playing out, or what is amiss so that 20 years time span makes a good amount of strategy and a good amount of money for the investors? So what is not in place for NTDOP?
Yeah. No, so everything is in the right place today as we speak for the NTDOP portfolio in terms of our portfolio construct and all the things which I've spoken, whether what are the themes we are participating in it and whatever stocks we have. So I think the fundamentals of the portfolio looks stellar right now. Again, just to update you, as per the latest numbers, NTDOP now on a 1 month, 3 month, 6 month, 1 year basis is demonstrating meaningful alpha also. So this is a long, very old product of ours. It was a product which we launched just before global financial crisis, right? So this portfolio has seen a lot of headwinds and tailwinds.
So
It
the moment
actually
you launched it, the
it
2008
went down
happened.
by 60%. So 100 rupees went down to 40 rupees, right? And that 40 rupees today would be, so let's say a 10 rupee NAV to begin with, today is about 110, 120. So it's a 10x over the last 17 or 18 odd years from the time the fund got launched. And somebody who would have bought in the Lehman crisis would have made even higher returns, obviously, because the starting point would have been very, very low. So yes, the long-term returns look good. In between, I think between 2019 and 21, the fund went through massive headwinds. Uh, the kind of names we had uh, were very, very high quality names. There was a lot of protection in those names, uh, very good businesses. But I think what was missing was the growth side, right? Uh, Probably what we should have done in that phase in 2019 to 21 phase or 22 phase is done a very to do a very quick turnaround in the style and the underlying portfolio. So it took a lot of time for us to figure out what went wrong, what is not working, and then to course correct it. If I'm not wrong, in 2022, the first thing we did was there was a change in the manager. So the original manager was managing the portfolio since inception till about 2022. He moved on, and we introduced Vaibhav Agarwal, who's also our CIO for alternate business. So the CIO leads the portfolio which is going through the maximum pain. And ever since 2022, this portfolio has been through a complete turnaround. It is now well aligned to our overall philosophy, overall portfolio integration with the comfort of the investment team, right? So the whole, what do you say? It is actually, it went into the hospital, right? The surgery is done.
So
The
was
pay,
not in the ICU, it
the
was just in the
it briefly went into ICU also,
okay.
right? So from ICU to recovery, I think this portfolio is more in a recovery stage right now, where the patient is just about walking. It has to sprint and it has to run fast. It is all set for a comeback. The initial signs are looking very, very promising. Unfortunately, the markets also go through has been going through a lot of volatility, right? Returns will come when the markets are in great momentum. So once that happens, I think this portfolio is poised to benefit from the momentum when the market gets into the momentum. But for now, we are seeing the green days are coming back and the red days are going behind. You have to remember, and you have been in the business for long term, uh, it takes time for the portfolio to actually go down, but equally it also takes a lot of time for the portfolio to comes
To
up.
come up.
So when your portfolio is down, first year one day gets better, then 1 week, then 1 month, 3 month, 1 year, then 2 year, then 3 year, then 5 year. As long as the journey of recovery has started, as you are seeing more number of positive days than the negative days, that means that slowly, steadily, you are going in the right direction. In fact, that becomes the best time to actually buy.
So I truly appreciate your conviction on NTDOP that it's on its way up. Uh, but when I look at the four funds of Motilal Oswal AMC, NTDOP, Value, Mid to Mega, and Founders. Okay, all of them multi-cap.
Yeah.
Number one, all of them have similar sectors. All of them have overlapping stocks. The philosophy remains the same, QGLP, that's quality, growth, longevity, price. Okay. Also, we say, as you say, that buy right, sit tight is applied to all four of them. Yeah. So we want to understand what is that differentiation that the investor is getting from four different products, or is it just packaged to be capturing more shelf space in the market?
Right. So let me first correct couple of things.
Yeah.
So there was a time and moment where we practiced the buy and hold philosophy in our portfolios. We believe that if you buy into good businesses, hold on to them for long periods of time, eventually good businesses will result into good returns. But that was good up to a point of time. Over the last 5 years, the market cycles have become short. return cycles have become short, so therefore you have to be a lot more active. That's the first thing we changed in our investment philosophy, is to be a lot more active, be a lot more aware of the newer opportunities, a lot more aware about valuations and all of those things, which will naturally lead to a higher churn in the portfolio, because uh, because eventually in public money management you are appraised on a daily basis, right? So you have to be very, very active, right? Yes,
So buy
investors,
right, sit tight is no longer
it's no longer our investment philosophy,
philosophy.
right? We are actually complete opposite of what we were practicing 5 years back, which was buy and hold. Today we are a lot more a lot more active, right? So just wanted to kind of correct that. Second thing, we have four themes. Our alternate portfolios are differentiated from our mutual fund portfolios by the construct of the portfolio. So if you see, our mutual fund portfolios largely would be market cap bucketed. So large cap, mid cap, small cap, flexi cap, so on and so forth. But our alternate portfolios are theme based products. NTDOP is a theme, next trillion dollar opportunity portfolio. It was launched when India was a $1 trillion economy, right? Today it's become a $4 trillion economy. It will become a $15 trillion. So as India's economy is growing, which are the spaces which will grow alongside the growth of the economy, and that is what the fund is trying to participate, irrespective of market cap. It's a flexi cap kind of style, looking more at NT-DOP opportunities. Look at the founders portfolio, which we launched for the first time in 2023. So it's kind of completed 3 years now. Now, founders by name is a theme where we are investing in the founders of India, or participating in the entrepreneurial growth story of India. What we have seen is that in the last 2 or 3 decades, maximum wealth creation has happened by companies which are owned by entrepreneurs, and not public sector as a ownership kind of criteria, or multinational companies. There are three ownership structures, right? So what we feel is that India, as it grows, will throw up a lot more entrepreneurship, a lot more innovation, and if last 25 years HDFC Group has been one wealth creator, or Kotak Group has been one, or Bajaj, or these names which are now household names, after 25 years the names will change, right? These names have become very, very large, but newer names will be grow at a faster. So this fund is trying to play at the India's entrepreneurial journey. So in the portfolio, you will not find public sector, multinational, but you will find a lot of entrepreneurs, new entrepreneurs, businessmen, right? All those kind of things. So that's one second theme.
Okay.
Third is a mid to mega. Now, mid to mega by name, see, the name itself tells you what the fund is all about. Mid to mega. Largely, this fund is themed around buying certain small cap, mid cap companies which have potential to migrate from being a small cap to becoming a mid cap, or mid cap to becoming a
Large cap.
mega cap, right? Again, in the data, what we have seen is that every 5 years, 14 to 15 companies migrate from mid cap to large cap, right? Therefore, we started putting our heads to work out, and there is a wealth creation study done by Ramdev Agarwal himself in 2017 on the wealth creation is titled Mid to Mega, where this was thrown out that every 5 years, 15, 16 names actually move from mid to mega. So we try to understand that, okay, what are the uh, why are these companies, what are traits of these companies that they become multi-baggers in 5 year period, they grow at 30-40%, and therefore they move from being a mid cap to a large cap. And so again, if you buy a great story in making over the next 5 years, uh, some great innovation or some turnaround is happening, or something is happening in the business, where into the next 5 years the growth rates compound at a very, very high rate, or the ROEs improve, and because you are identifying them early on, you will get them at lower valuations. So if you can identify tomorrow's growth today and buy it at today's valuation, which will be lower, then the probability of getting right into buying into one of these 15 companies will be very, very high. So our whole thought was that if I create a 25-30 stock portfolio, and in the next 5 years, even if I get two or three names right, I think our job is done, right? Because these companies will give me 30-40% compounded. Rest of the companies, even if they give 12-13%, the average return will be very, very high. So it's one of the unique mid cap fund, which is a low churn mid cap fund. The churn in this portfolio is very, very low, because we are doing a lot of research to identify bets for the next 5 years. We want to actually see and give experience to investor that in your account we have bought these names, out of which you have experienced businesses which have become small to mid or mid to mega or small to mega, whatever, Now, this is a 6-year-old portfolio. 2019 is where we launched. Again, just before COVID, right? So it's been through COVID.
So
it's been
either
through,
you are before Lehman
yeah,
or
so
you
we
are
are
before.
we always do innovation at the top of the market, right? And then we see the headwind first. Despite that, in 6 years, there is a smoking gun. There is a proof to the concept. We've got 9 companies, where one company we got mid to mega right in 5.5 years, which was this company called TVS. We bought at a 44,000 crores market cap. Today it's a 1,25,000 crores market cap. So we got a 3-bagger and we got our mid to mega right, one of them. But we've got almost 7 companies which migrated from small cap to mid cap,
Okay.
right? A lot of names, and we have sat through these names, right? So in some way we are practicing the buy and hold in this particular portfolio because the design of the portfolio is like this, right? So whether it was
So what are these 7 names that?
so let's say, on top of my mind, Persistent and Coforge. Today they are all very known name because they have compounded, right? But we bought them back in 2020 when these companies were trading at 4-5,000 crores of market cap. Today they are 70-80,000 crores of market cap. It's a 10x, right? We were early ones to buy into Suzlon in this portfolio, Angel One in this portfolio, BSC in this portfolio. A lot of these names 5 years back, nobody knew. Today they are talked about because they've become big, right? But in my portfolio, my customer who has come 5 years back, in his demat account, he's actually seen these names: 10-bagger, 15-bagger, 5-bagger, 3-bagger. And this portfolio now, over the 6-year period, 2019 till now, is compounding at about 20 to 23%, 4% higher than the benchmark. That's a mid to mega theme. It is not like a regular mid cap fund. It's a theme based fund. Third, value migration. Now, what is value migration? Basically, what value migration by the title means is that value in a business migrates from time to time, from let's say in a simple way, profit pools will migrate from one business model to other business model. Value migration can happen from one country to other country. China plus one is a value migration, right? Some of the ways you want to understand this is, let's say, from thermal power dependency into renewable power is a value migration. That incremental newer capacities are getting built on the renewable power side. Therefore, the profit pools will migrate from the companies which are based on coal and largely thermal based into the renewable, and therefore the new opportunity will create there. Or let's say 15-20 years back when private sector banks started to grow fast. So public sector today from 100% market share in banks in favor of public sector, today they have come down to 60%. 40% of the market share has moved to private sector bank, and therefore one HDFC bank got created, one one Axis bank got created. That's telecom. The first value migration happened back in 2000, 2001 when Bharti got listed, when you moved from a wired phone, your old traditional phones, into mobile phones. And that mobile phone is also now migrating into data, right? Today, everybody does WhatsApp call rather than, I think the bill in your mobile phone for using the telephone is actually zero.
Yeah, it's the Wi-Fi.
Largely you pay for data,
Yeah,
right?
you pay for the
so data is the next level of value migration which is happening. So right, so I can go on and on. There are many such spaces where the profit pools are changing hands. In this fund, we are trying to identify such opportunities where such events of value migration is very, very visible. Buy them as early as possible and then sit through it. This portfolio has been through a change. It's our first alternate portfolio we launched in 2003. Largely, it was value strategy. 3 years back, we changed it to value migration. So therefore, you have to see this portfolio in 2 cohorts: 3-year how it is done and 20 years, because 3-year is a different format. It's a different theme, right? But yes, now this is one of our fast growing products. And finally, fourth one is, I think we covered all 4. So we covered NTDOP,
the NTDOP,
we covered
founders,
NTDOP, founders, value migration, mid to mega. All 4 themes. Now you can buy any of these themes in isolation, or you can make a combination of this, and you can buy through our portfolio management product, or you can buy through our AIF product. We have only 4 unique portfolios.
Okay, so coming back to the PMS, when we see the cash holdings, it's around 12,000 crores is managed in the PMS. Cash holding is around 8% of that.
No,
So
zero.
So the latest statement that we saw was around 8%. So 10% was in NTDOP, mid to mega had some 6%, valuation had 5% cash. It came to around 800 crores. Maybe now you have deployed
Deployed it.
it, or what's the current situation? Because we get the statements after the 10 days of the month end, right?
Yeah.
So we want to understand this holding of cash, 800 crores, at any point in time, isn't it a huge sum that is lying idle for a AMC or at the fund level?
See, philosophically, we don't believe in cash calls. Fund managers, even if they have 5%, 6% or 8% cash at some point of time, it will not be because they are taking call on the market. It could be because they would have booked profit into some portfolio, or there is fresh cash which has come of the newer investors which are coming. Therefore, it takes little time to reallocate that cash. And so sometimes maybe you're saying that last month you saw 6% cash. Maybe it would be more about that rather than we don't time the market. Very, very rarely in the last 23 years of our asset management business have we tried to time the market. We have done once or twice, not that we have never done it, but more often than not, at least in our case, we have been unlucky when we do cash calls, right? We did the first cash, I think, at least in my history of working in MO, the last we did in end of 2024, when the markets were going up every day, new highs every day. It was looking very, very, very expensive. And therefore, as a risk measure, we thought that, okay, let's build in some cash and wait for the market to cool off before you keep buying higher and higher and higher. So that was a
So
very,
that was 100% cash call, or
no, no, no. It was like between 10 and 20% cash call. Different managers took different call, but we slowed down. And fortunately, it worked for us because in Jan, we saw the correction actually came in. Jan, Feb, March 2025 is when the markets actually corrected. And very quickly, we deployed also the cash. Iske pehle, the call we had taken was in the Ukraine-Russia conflict. Briefly, we built the cash position, and it hurt us because markets actually came back very fast, and we took time to deploy. Therefore, there was underperformance for some time, right? So this cash call is according to us at least, it's not the right way because investor is doing his own asset allocation. Whatever cash he wants in the portfolio, he will keep it cash, and whatever money he wants to put into equity, he will give to us in equity, right? So unless there is a rarest of the rare event or something really crazy going on in the market, and from risk perspective, I need to build cash, we will build cash in the interest of investor. But otherwise, the philosophy is to be fully invested at all points of time.
okay? So coming to a conclusion to this podcast, and just wanted to give you opportunity to say to your investors as to what you feel that 26 is going to look like and 27 is going to look like. So any message to the investors that you want to give?
See,
And
it's
there's a big lot of bunch
yes,
of investors out there
yes,
of
yes.
MOAMC.
Yeah, yeah. No, so I think given where we are today from geopolitics perspective and geoeconomics perspective, things are not looking too rosy in the for the immediate short term, right? Things change very fast. Things are changing overnight. So in this kind of a macro situation, one should not have very great expectations from markets per se right now. I don't know how the year will end because this whole war thing, which is largely looming over us, I don't know when this war will end, and then the after war consequences, what will be the damages, to what extent, I don't know all of those things, right? So given this kind of a situation we are in, uh, try and take advantage of these corrections, try and take advantage of this volatility. You are getting great businesses of India, or these great businesses who are trading at rich valuations today, they are trading at good valuations, right? So if you liked India 2 years before, you should like India even more today because you are getting a lot of stuff at a much better price. So in such periods, such phases of consolidation, be a buyer, be a ferocious buyer, take advantage of the corrections, and then wait for the market to settle down, all these clouds to kind of clear out. And when there is a bright blue sky after 3 months, 6 months, 1 year, that will also reflect in the markets. And those people who buy on dips make much, much healthier IRRs than those who buy only in the in the tops of the market, right? So my suggestion is that things are not clear. Broadly, these are global events. It's not that India is impacted because something wrong we are doing to ourselves. It is the global events which are likely to impact us, which is creating volatility, which is creating good valuations, which is creating a good opportunity. So don't fear, right? Be optimistic. You can be cautiously optimistic. Try and allocate some parts of your savings or your investment pool or your cash over a period of time. Don't go all in immediately. Every time the market goes down percent 2%, move in. So do the allocation part at the lower levels, and then leave it for couple of years, and things will be sorted out. So I think these are times to be more excited than rather than being more worried. You should be worried when markets make highs. You should not be worried when markets are making lows.
So markets are making lows, and you should be an investor who buys on dips, and that is what the advice is coming from Mr. Akhil Chaturvedi, from the executive director from Motilal Oswal AMC, and we had a great conversation with him. Friends, this is one thing that is going to be very informative. So please go through this podcast and be a great investor. Thank you so much. This is Narender Agarwal from Wealth One, and we sign off from the platform Returns and Beyond. Thank you. So, we've had a wonderful podcast, but would like to say that a small disclaimer that all the things that we have said is for educational purposes, and the viewers, the investors, are requested and instructed to please take your own decisions while you're investing